Hello, everyone. Good morning, good evening, or good afternoon, depending on where you are. Welcome to our webinar. Today, we're going to talk about what to expect with AI in 2026. So our predictions on the future of models, investments, and impact. My name is Arie van Berkel. I'm Chief Product Officer here at Lux Research, and I'll be moderating today's session. Presenting today is my colleague, Anthony Schiavo, who's a Senior Director and Principal Analyst, also here at Lux Research. Now, before we start, a couple of household items. If you have any questions during the webinar, please don't hesitate and ask them. And you can ask them by typing them in the questions box that you can see for me, it's the right, I'm assuming for everyone, on the right of your screen. Time permitting, we'll be discussing some of those questions at the end of the webinar. And if we don't get to your question, or if a question occurs to you while thinking about this webinar, maybe tomorrow, then don't hesitate and email us at questions@luxresearchinc.com. So that's questions@luxresearchinc.com. I'll show you that email address at the end of this webinar as well. We will get back to you by email or otherwise to those questions that you ask later or that we don't get around to. All right, well, now, if you experience any technical issues, experience shows that just refreshing your browser helps. So refresh your browser, check your audio connections, check your internet connection, and you should be good and be reconnected. All right, without further ado, let's see what the future, or at least next year, holds for AI in 2026. Anthony, the floor is yours.
Thanks, Arie, and thanks everyone for joining me today. I'm Anthony Schiavo, and I want to start, since we're talking about predicting the future, I want to start with maybe my favorite chart from the year here. This is from the Federal Reserve Bank of Dallas here in the United States. It is a forecast of GDP per capita. You can see the trend line, which is this orange line of GDP per capita, going back to 1870. And you can see the potential AI-boosted trend of GDP per capita going forward, which is a 2.1% growth for 10 years, as opposed to the current trend of 1.9% growth. And then you can also see two other scenarios that the Federal Reserve has chosen to model. First is a singularity scenario in which money, I guess, no longer becomes real. GDP becomes infinite. We all live in total abundance and presumably harmony. And then, of course, we have the other scenario in which the human race is killed by AI and goes extinct within about the next decade. And I guess GDP goes to zero in that scenario, which was not good for an economic perspective. Of course, presumably also bad because we're all dead. But this is I show this because it's funny, of course. It's kind of a goofy chart, but it also shows, I think, the difficulty of making predictions about AI, right? If you take either the doomers or the sort of utopians seriously, then things are going to be very, very different a decade from now. But saying, well, maybe GDP will be 0.2% higher per year on average over the next decade doesn't really capture all the changes that seem likely to occur as a result of AI. So I'm going to try and provide a slightly, more detailed scenario forecast than this, and something in between these different scenarios. We're going to start by looking back to some of the predictions we made last year, and then looking ahead and making some predictions for next year on model development. Then we're going to get into data center, and particularly data center investments. This is obviously a huge topic. There's trillions of dollars being spent. Is that money going to actually get a return? And then we're going to look at longer term scenarios for AI adoption and also AI impact. What does it really mean when we talk about the long-term trajectory of AI? And we're going to be using this definition of AI, that AI is a probabilistic tool, that it's trained on large amounts of data, and that it can replicate the output of complex tasks. And this is the definition that we've been using for almost 2 years now. We think it applies about as well to large language models and large image models as it does to the more scientific in much smaller flavors of AI, things like materials informatics. So this is our very general definition of AI. So what did we predict last year in 2024 about AI? And these are from late last year, so October, just about 13 months ago. First, we predicted that AI models are becoming commodified and will be commodified in the next year. Two, that AI companies are going to have to change their business models to start making money. And three, we predicted a crash. So let's go through these one by one. First, on AI models, we are definitely now, I think, in an era of model commodification. Both at the leading edge, you can see this is data from LiveBench, which is a AI model benchmarking open source project. The cutting edge, the top models, you have models from Anthropic, OpenAI, and Google, all in those top 4 spots. And that in terms of these benchmarks, they're performing all pretty much the same to each other. So any performance lead that OpenAI may have had in the past has now been erased, and it's really everyone's equal at the cutting edge. And then also you have in this sort of middle tier of performance models that are a little smaller, that are cheaper to run, good for a lot of different applications. You have a similar story. Lots of different models from different providers, OpenAI, Anthropic, but also Chinese companies, Alibaba and DeepSeek. DeepSeek made a lot of noise, got a lot of attention earlier this year, but Alibaba has also been doing a lot of great work in AI. So I think we're now fully in this era of model commodification, and I don't think this is even really a controversial point anymore. Secondly, we've definitely begun to see that pivot towards consumer business models, at least from OpenAI and from Meta. Now, Meta, of course, owns Facebook, and they were probably always going to have some sort of consumer pivot. They introduced Vibes, which is essentially a quasi-social media style app for sharing AI-generated videos. I say quasi because there's nothing really social about this media. It's all AI-generated. But what's interesting is that OpenAI has done something similar. With the launch of Sora 2, their new image and video generation model, they also released the Sora app, which has many of the same social features, a scrolling feed, the ability to share videos with your friends. So clearly there's a desire here to tap that consumer market. And we haven't seen a crash yet, but fears of a crash are definitely growing. And there's been a lot of cracks beginning to show, especially in these sort of debt-funded data center build-out. These are all headlines from Bloomberg within, I believe, the last month. Fears of an AI bubble, and sort of changing opinions on some of the value of some of these stocks and some of these companies. Now, we haven't had a crash yet, and we're going to talk more about this in the second section on data center economics. So I'm going to leave it there, and I'm going to come back to our prediction of a crash. Instead, I want to make some predictions that are a bit more model specific for 2026. And we're going to focus on 3 areas. First, mini models. We think they're going to become a lot more powerful and a lot more widely adopted. We're going to see a shift in R&D to world models. And then we're also going to see a lot of action on image models, especially application development for image models. So mini models, what are those? As you'd expect, these are large language models that are not so large. They are much smaller in terms of the number of parameters, so the actual size of the matrix multiplication that's happening. And what is already happened is that mini models are about as good as ChatGPT 3.5. So when ChatGPT really launched, or when it really became GPT 3.5, that was what was in ChatGPT. That really kicked off this whole AI boom. And we now have very small models that are roughly similar performance. And you can see this again from those leaderboards, Gemma 2.9b, that's a Google model. And there was this interesting paper, again, published within the last month, because benchmarks are always a sort of better is better, right? You can always score higher on one of these AI benchmarks. But in a lot of real world business tasks, good enough is good enough. And so that's what this paper was testing. They had this requirement classification, which is this sort of early step in software development when you figure out all the things you're going to need. And they tested 4 or 5 different small models, these mini models, against cutting edge AI models. And there's a lot to get into, but ultimately the mini models performed slightly worse than the very large models, but only very slightly. And what's important to recognize is that with these mini models, A, they are many open source versions of these, and B, there's some Chinese versions of these as well. You see Qwen 2, that's from Alibaba. So these are designed to be run on edge devices, so regular computers, or potentially on-prem servers. So I think it's very likely that we're going to see another step up in the power of these mini models. If we can get close to something like GPT-4 with a mini model, then I think that's performance that's good enough for a lot of business applications. And that can be run in areas where security is really important. You can run it on your device, you can run it on your existing cloud environment, and it can fit within your existing security infrastructure. So this could be really impactful for a lot of business applications in things like law or things like medicine, or even corporate areas where security is important. Second thing, we're going to see a lot of attention on world models. There's been this, I think, growing consensus and growing recognition that we're at the limits of large language models, especially when it comes to reasoning. There was this paper from Apple Machine Research this year that sort of demonstrated that even for relatively simple logic puzzles, once you made the sort of the number of steps or the complexity of the puzzle sufficiently high, no amount of additional compute or additional reasoning enabled these large language models to solve these problems. So they really struggled there, and you can see that additional reasoning helped as the problems got more complex, but ultimately you just sort of hit a limit of that. And a lot of AI researchers now think that large language models are not really a path to AGI, whatever that is. And we've seen that top researcher Yan LeCun has left Meta. He's developing his own startup, and he has been a longtime proponent and developer of world models, where the model itself has a bit of a, not just doing text prediction, but has a structured understanding of the world baked into it. And so I think we're going to see a lot more interest in these types of world models this year as these more advanced companies raise funding and as people sort of try to follow in the wake of this AI pioneer. And lastly, I think we're going to see a lot of interesting stuff happen with image models. One of the most sort of fascinating stories of this year was the rise of AI music and AI artists. So you have Xenia Monet hitting the Billboard charts. There was a country song that hit the Billboard charts. And you may be wondering, well, why am I talking about these pop stars and this music when I'm on a slide about image models? The reality is that these image models are actually how this music is generated. You take an image diffusion model and you use it to create the image of a waveform. And with sufficient training and with sufficient data, you can actually develop a model that can produce things like drum beats and individual sounds, whether that's a cymbal or various instruments or even a human voice. So image models are what power apps like Suno that have created these AI artists. And it just shows that there's a potential huge amount of information that is encoded in a visual image, right? We think of that as pictures of the street, but it's charts, it's graphs, it's these audio waveforms. It could be any huge number of other things, right? So there's really a ton that can be done with image models. Everything from automation to error detection in manufacturing applications. We've already seen some applications in medical diagnostics. There is a huge amount of potential use cases for image models. And I don't think we've even really seen nearly all of these applications be developed. So I'm expecting a lot of activity and a lot of hype around image models in 2026. Okay, so we talked about models. Now let's kind of get into data centers, right? And And I think the big question is can these data center investments really make money, right? And it's an important question because there is a huge amount of money being spent. On the chart on the right, this is data from JP Morgan and Bloomberg. This is the CapEx commitments of just 4 companies, right? This is just Microsoft, Amazon, Meta, and Alphabet, or Google, right? They're committed to spending about $1.1 trillion on CapEx this year through 2027. So in 4 years, more than $1 trillion. This doesn't include OpenAI. OpenAI is committed to spending an additional $1.4 trillion in CapEx spending. So we're talking about, at least $2.5 trillion in CapEx, if not more, on data centers. So the question is, can this ever work out? Can we ever make money on this spending? So I want to dig into some of the data around CapEx and OpEx. What you see on the right here is representative CapEx for a 50 megawatt data center. Now these are Lux estimates. We've read the literature, we've done some interviews. This is what we think is roughly representative. I will say there is a lot of variation. Individual data centers are very different from each other in terms of size. They're very different from each other in terms of location. All this stuff impacts costs. There's a lot of different ways that can be financed with debt. I'll get into that a little bit later, but I want to just make the point. This is not trying to represent any specific project. This is just trying to give you a general sense of, on average, what things roughly are going to be. So take this with a grain of salt. Recognize that there's a lot of variation. In general, a hyperscale data center is going to cost you around $10 million per megawatt of IT load, maybe more, probably more going forward. So for our 50 megawatt data center, we have about $500 million, $510 million or so of CapEx. About half of that is IT equipment. And that's really this is an AI hyperscale data center. That's really going to be your AI chips, your GPUs, and your racks and your other sort of supporting infrastructure there. And then you have the shell of the building along with the power and cooling equipment. So that's your electrical infrastructure, cooling systems, and your building and your civil works. And that is going to be another, solid 35 to 40%, right? And then your remaining spend is on things like design, contingency, but it's really, that IT equipment, and then particularly electrical and cooling. Those are your big centers of CapEx. And this is important because your IT equipment has a much shorter depreciation life than everything else. If you have a 15-year depreciation for your electrical and your cooling, your GPUs might depreciate in 4 years. And companies have been extending that depreciation life out, but it's still quite short. And this is important because when you think about your operational expenses, depreciation is number one, right? You have these GPUs that are these rapidly depreciating assets. So you need to get as much revenue out of them as possible. Then you have your power. Now we're assuming here electricity costs of around 8 cents USD per kilowatt hour. That's quite low. We think that's reasonable for industrial companies. It's about half of what a consumer pays on average for electricity. But that could go up a lot, right? We've already seen that electricity prices have been rising in the US very quickly, but it sort of highlights why companies are trying to secure access to clean power and reliable power, right? Because if that doubles, that would be very, very expensive. That would add really significant expense to our data center here. But still, in general, we see that depreciation is the biggest cost, and then everything else other than power and depreciation is really quite small. So it's really these two factors. And what that means is that our data center is sensitive to a couple things. If we want to be profitable, a few things matter to us. The first is GPU life, right? This is not the same as the depreciation period. This is the actual working life. And one of the big concerns, you've seen people at OpenAI talk about this, is that the GPUs are going to end up having a really short lifetime, especially in these AI data centers. They could be run very, very hard at sort of full capacity, very hot, basically continuously. And that might mean they might have a life of 2 years or potentially even less. And that means they need to be replaced, right? Every time you replace them, you have to pay a lot of money, probably about $200 million in our 50 megawatt data center. And that really increases your depreciation expense quite significantly, really increases your total costs. And then there's a question of usage and uptime, right? Ideally, you're running these data centers 99% or more. And many data center agreements ask for 4 nines, 99.99% reliability or more. But if you are running, for example, a data center where you are sort of renting out GPU time to different consumers, it's possible your uptime could be a lot lower, right? Because so much of our OpEx is this depreciation expense, even a relatively small reduction in uptime really hurts our profitability, right? We really want to be maximizing this uptime. And then there's the question of the price. How much are we actually able to charge our customers for the GPU hours that we're providing? Now, if you go out and you rent a GPU today through one of these cloud providers as an individual or a small purchaser, you might pay a price as high as $2 an hour for that GPU. That's often the price you see quoted. And at that price, data centers look extraordinarily profitable. They look insanely profitable. That's a great price. But we don't think that's very realistic, right? We've seen from Oracle, for example, which has gotten into providing data center capacity for OpenAI, that their margins on this business are actually really quite low. So there's no way that Oracle is charging OpenAI consumer level prices for their GPU hours. So we think something around the realm of 40 to 50 cents is more realistic. That still can be quite profitable at that range. But if that price dips down into the more 35 cents per hour range or lower, you really start to take a hit on profitability. So if we're at, if any two of these factors come true, our hypothetical data center is ultimately not likely to be profitable. Now, this is based on a 50% debt load. This is based on a bunch of different factors. Again, I sort of mentioned that every single data center is different. If you're a hyperscaler and you are funding your data center build out with cash, not with debt, then you have more room to play with. But even the hyperscalers are using debt now. We see that in the Meta Blue Owl deal. And many data centers are being developed with very high debt loads, as high as 80% or 90%, especially for those neo clouds. So there's some folks that are doing this in a very risky way, right? And they're going to have a much thinner margin, right? But the point I want to make is that, this sort of illuminates what the risk factors for us really are. And I think they are these two scenarios. One is that models get a lot more efficient, right? And we talked about mini models. Maybe everyone switches over to mini models. And much of the business use either is in data centers, but on these very small, very efficient models, or migrates away from data centers, right? Migrates to the edge, migrates to on-prem servers or computers. That could pull a lot of demand away from data centers. And when demand drops, you're going to have a double whammy of lower prices and lower utilization. It's really bad for profitability. If you combine this with lower GPU lifetimes, that's a major concern. Second is oversupply of GPUs. NVIDIA said that it has, I think in the last year, sold more than 6 gigawatts of GPUs for AI. We're not building, or turning on 6 gigawatts of data centers in the last year, right? So we know that there's a huge amount, gigawatts and gigawatts of chips out there that have been produced that are waiting to be turned on. And it's entirely possible that, in the next year, in 2026, data center development takes about 3 years. If you started in 23, late 23, as the hype around ChatGPT really started to explode, we're going to start to see a lot of data centers and a lot of GPU capacity come online in 2026, especially towards the later part of that year. That huge wave of GPU supply could really, again, similarly, lower utilization and lower prices, right? And that's the double whammy that makes these data centers not profitable. And ultimately, that's the sort of, either one of these scenarios or both of these scenarios coming true at the same time, that is the kind of thing that could lead to a crash. And that is what we expect to happen. I do believe there will be a crash. I continue to support that prediction I made last year. And I think this is how it's going to go down. I think we're going to see models get smaller. I think we're going to see models get powerful. I think we're going to see AI shift more and more to the edge. I think we're going to see it shift away from data centers. And at the exact time it's shifting away from data centers, we're going to see a huge expansion of data center AI capacity of these GPUs. It's going to crush prices. It's going to crush demand. And the returns are going to look bad. And the debt that's been taken on is going to no longer be serviceable. Now, we could talk for a really long time about what that means for the global economy. That's not this webinar. We're going to leave it there we do think a crash is going to happen. And I want to talk now about 4 longer-term scenarios for AI. And the point I want to make is that in these long-term scenarios, all of them are compatible with this sort of near-term crash, right? And I don't necessarily think that the near-term crash, you should not take it as a sign that AI doesn't work or is bad. It's quite the opposite. I mean, one of the things that's contributing to the crash is these models are improving really quickly. So what then are these 4 scenarios? I've given them cute little names here. We have slop future, work future, tech future, and trash future. These are our 4 possible scenarios. We'll go through each one in turn and talk about what they mean. In our slop future, it kind of turns out that the best way to make money from AI is with consumers. It's from consumer applications. And in turn, you have the large AI companies really pivoting towards consumer applications and developing for consumer applications. Facebook, Meta, possibly OpenAI are kind of the big winners here. I think for the business community, the point that I would make is that this future scenario will really constrain model improvements. Companies are not going to be spending tens of billions of dollars in this scenario to make models that hallucinate less, right? The cutting edge of model development for business applications is really going to slow down because they understand in this scenario that spending won't generate returns, right? And instead, spending will focus on, I think will shrink, but it will focus on areas that are likely to generate returns, things like image models, especially optimized for consumer video, and again, less for industrial applications. Our work future, this is sort of close to the promised land of AI. This is where AI is going to add meaningful productivity gains, economic productivity gains, right? Maybe even more than that 2% per capita than the Fed predicted at the start of our presentation, right? I think what's important to recognize is not only does these productivity gains need to come from AI, they also really need to be captured by AI. So companies like Microsoft that already sell business services are in the best position to do this. Companies like OpenAI and Meta especially are worse positioned, right? OpenAI has already, I think, lost its lead in business applications to Anthropic. But I want to point out that a lot has to go right. We talked about this mini model scenario. It's very likely that you have a huge amount of efficiency from a business standpoint, and a lot of that is going through open source models hosted on the edge. And value capture could be very difficult for these large companies. So I actually think that this isn't that likely either. The scenario I think is perhaps most likely is what I'm calling our science future. And here, the benefits of AI are not really in the sort of huge boost to economic productivity as measured by GDP, but in the more technical or the more high knowledge applications of AI. Things like illness diagnosis, right? Drug discovery, materials development. These applications which create a lot of value, especially a lot of long-term value for society, but they're difficult for AI companies to really capture value again. And again, I think the AI companies in this scenario might not be winners. Perhaps Google and NVIDIA are. They're the most heavily invested in this type of science development. But the biggest beneficiaries are probably likely to be the users of AI in this scenario, the drug companies and the materials companies and the medicine companies, all these different, maybe robotics companies, right? These are the ones who will benefit the most. The reason why I think that this scenario is most likely is because it's less dependent on the AI companies themselves figuring out how to capture value, right? All you really need is for the tech to work out in this scenario. The AI companies themselves might still end up taking a bath, right? And I think the tech is the thing that is most demonstrated at this point. But the other likely scenario is failure, right? This is our trash future. Failure is very much always an option. AI can fail for just not being able to generate a return, not being able to capture the value it creates. It can also end up in a kind of a Bitcoin or a blockchain scenario where, a few years ago, all the blockchain companies were saying, we're going to revolutionize the world and every industrial application will be on the blockchain. Today, they're all just doing, it's pure finance, it's pure gambling, really. It's entirely possible that AI ends up in a similar vein where these companies just pivot towards financial applications. And there's a lot of AI work or a lot of AI value, but it all is sort of in this very abstracted financial landscape. It doesn't really impact the real economy. I also want to make the point about Apple here. Apple, I put them as a winner in this scenario because they've invested the least in AI out of any of the major tech companies. But the reality is they're probably going to be a winner in every scenario just because, no matter what happens, they can collect their 30% on the App Store. So with that, I just want to leave you with a few final thoughts. The key point from the presentation is really that, LLM development is slowing and there are these cracks emerging in the economics of data center build out. We are going to have a boom and a bust, right? We're still predicting a crash. AI, we still think is very likely to be useful, but AI is going to struggle to capture that value. Those AI companies themselves might not be very well positioned. And what that means is that you shouldn't overinvest in AI solutions, especially as the models are going to get smaller and you're going to increasingly be able to bring them on-prem. You should really be thinking about that. And you shouldn't overinvest in supporting the data center build. Now, don't get me wrong. I think data centers are still going to be a growth part of the economy, but it's going to look more like moderate growth, maybe 5% growth per year, as opposed to that wonderful chart we saw at the beginning where the line goes straight up. With that, I want to say thank you. And I think, Ari, we've got a little bit of time for questions.
All right. Thank you, Anthony. I'm glad we have time for questions because they've been already coming in as you were talking. So we're seeing quite a few reactions. Seems like people are still more than happy to talk about AI, at least. So I'll go through them in order of your presentation, just a couple of things that I noted. And I know there are many more questions. We won't be able to get through everything. So please continue to submit your questions. We will get to you in email or even call you. So there was something about commoditization. You were mentioning that AI models are getting commoditized. There's a bit of an argument here in the Q&A section because yes, maybe they are getting commoditized, but it also seems that all of the different models appear to have their own character. So, and whereas commoditization means you can get potatoes and they're all potatoes and it doesn't really matter which brand you buy. So here, are we heading more into the future of the car industry where yes, they're all cars, but they have their own look and feel to it? Or how do you see that developing?
I'm a little skeptical about that. I think when you dig into it, you'll see that a lot of these companies have the capabilities. I mean, there are models that are fine-tuned for different tasks or better at different tasks. But when we think about the model providers, all of the model providers have those models, right? So, Alibaba has a model that's fine-tuned for coding, right? And I think there are some businesses, right? I think you're going to see that differentiation on a business standpoint. So maybe it'll be a little bit like cars, where some car companies are more specialized in trucks or more specialized in sedans or whatever. But I think that the gap between the specialized models and the general purpose models is shrinking. And I think that all the different companies at this point have models that have been specialized for those different applications. So I don't really see that as like a major point of differentiation in practice.
Right. Okay. Yeah. So I'm sure the discussion will continue, but that's good to have your point of view there. There was another, I think some people are still maybe not completely agreeing with our prediction that there will be a crash at some point. Just the timing is difficult. And some people are making good points there. So you argued models are getting more efficient, so we need less compute anyway. But just a couple of slides before, you argued that there's new types of models like world models evolving. Wouldn't they increase the need for data centers?
Yeah. So it's really an issue of timing, right? The long-term trajectory, 2035 or 2040, is definitely that we need more data centers than we have today. You know, I've never subscribed to the notion that we're going to need less compute in the future, right, than we have currently. The problem is really one of timing, right? I showed those depreciation periods. We have a very fast depreciating asset in GPUs, right? That means you really need to generate the revenues in the next 4 years or so, right? And so it's not just about the business, you know, it's not just about the long-term development of those applications. Something like world models, that's a much longer-term prospect. Even those image applications I talked about, you can demonstrate the applications, right? But we have to generate the revenues, right, from those applications. That takes time because it means businesses or consumers have to change their practices. They have to sign up for things. They have to change how they operate. All that stuff takes time, right? And so there's a real timing gap between when we need to generate those revenues, which is in the very near term, especially for a company like OpenAI, which is under an immense amount of pressure on their revenues. And you know, the huge amount of the spending on AI today that actually operates these data centers is coming from debt, and it's coming from venture capital, right? VC companies are raising lots of money. They're spending it on data centers, or companies like Microsoft and Facebook and Google are funding this, right, by investing with things like credits. So there's still a really huge gap between the revenues that are being generated by AI and the cost of AI, right, especially the capital costs. And the question is, can that gap be closed in the next 2 or 3 years or 4 years maybe? I don't think so, right? And so it's really a timing issue. And that's why we're really talking about a crash in the next year as that issue becomes unignorable, right? But that doesn't mean the long-term trajectory is bad, right? And quite the opposite. I think the long-term trajectory for AI is towards being useful.
I'll try and get 2 more questions in. And there's more questions out there, but I think there's 2 more that we can potentially discuss that would benefit a lot of people. Talking a bit more about the crash, right? Let's make it a concrete thing. The crash, it's coming. Now, you talked about depreciation, and wouldn't that make this crash a little different from others, right? We've seen this before. There's a new technology, there's a boom in infrastructure investment. Those companies, they go bankrupt because they're basically building infrastructure out way too fast. They're too enthusiastic. Other companies scoop up those assets in foreclosure sales and things like that, and that enables the entire industry to grow because now you have cheap assets.
Yeah.
But you've got this depreciation issue. So you don't have cheap assets. You've got outdated, obsolete assets, even if you buy them from a foreclosure.
Yep.
So is this different? Is the crash not even going to help the industry here?
This is one of the big questions. You know, people have pointed to it's not easy to know. So first, I'll say that the data centers themselves, the shells, the electrical equipment, all that stuff, that has a depreciation life of about 15 years, maybe longer. So about half your CapEx is on assets that are a bit more durable, right? So there's still half the value there to be recovered in even the most worst case scenario, right? So that's obviously not good. You want more than that, but that exists. And the second thing I'll say is it's really not clear how much value can be created by second life GPUs, right? This is one of the big just open question marks, right? Are we going to have GPUs that have literally been melted because they've been run so hot and so hard? Or are we going to have, there are companies that already today buy second life computer equipment and use it in data centers, for cheaper compute. So like second life uses of equipment is possible, but it's really just not clear what the trajectory for the current generation of AI GPUs is.
Right. Okay. So something to watch. One really quick question, and then I think we really have to let our audience go here. But one really quick question: the work future. So this looking into the work future depends also on finding those initial applications that are worth billions. What's your favorite one?
My favorite one. I really like you can use image generation models to make synthetic images of what a video camera would see when it's inspecting a manufacturing line. And then you can use those synthetic images to train a model to detect defects and otherwise do quality assurance. So if you have a regular CAD model, you can go from a CAD model to a synthetic video or a synthetic still image to then train an image model to then detect issues in the real world, right? So there's a really powerful loop there of using AI paired with simulation to create data to train other models. And so for applications like in manufacturing, like quality assurance, I think you're going to see a lot of utility there. And that's obviously most impactful for areas where things are changing quickly. NVIDIA did a case study on predictive maintenance, on quality assurance in printed electronics. I think that's really interesting. So that's what I call out.
All right. Well, thanks. Thanks, Anthony, for the presentation and your questions. This concludes our webinar for today. The presentation and the recording from this webinar will be sent to all attendees through email. You will get those today. And after leaving the webinar, you'll be prompted to complete a survey. And those surveys are really helpful for us. So as a survey on today's presentation, please take some time to provide our feedback to us. It will help us really to improve our future webinars as well. And of course, take some time to check out our upcoming webinars on our website. Thanks everyone for joining. Have a great rest of your day, however long that may still be. And looking forward to see you in one of our next webinars.